All right, so it's a masterclass in regards to jumbo loan financing. So how high income and high net worth borrowers finance luxury homes, manage liquidity and structure larger mortgages strategically. So is a jumbo loan just a bigger mortgage? Not exactly. Underwriters and lenders may evaluate more documentation, complex income, investment assets, greater liquidity, multiple businesses, multiple properties, larger reserve stock compensation, right? RSU income. Post-closing strength is huge here. So jumbo financing is not only simply about qualifying for the payment, it's about structuring the entire financial profile. So today's agenda is going to understand jumbo, how to qualify for jumbo, discussing complex borrowers, structuring the transaction, the property, and strategy. The largest down payment is not always the best strategy, right? So a larger down payment may lower the payment, improve pricing, reduce debt, but retain liquidity, protects emergency reserves, preserves investment assets, support a business, right? Future opportunities. Jumbo financing should be coordinated with borrower's complete balance sheet. So conforming high balance jumbo, conforming loans with baseline limit, change year by year, currently at 832,000. High balance goes up in some areas to over 1.2, close to 1.25 right now in most Bay Area counties in Los Angeles. Jumbo is above that, exceeds conforming and high balance limits. So the property's county limit that really helps determine where jumbo financing begins. So as I mentioned, one unit baseline unit, San Francisco County, or in Marin County, where I am, right? Versus a max one unit high cost limit. So a $1 million loan may be a jumbo in one county and a high balance conforming in another. Why? Well, look at Napa. Napa doesn't have the high cost limit at 1.249. Okay. Either does Sonoma County and Solano County doesn't either. So California's non-one loan market, remember, right? So we have baseline counties, moderate high cost, maximum high cost. So before selecting the program, lenders generally look at unit count, the county, requested loan limits, right? So there's no universal definition. 2 million, 3 million, 5 million. Super jumbo is commonly used for a very large mortgage, depending on the lender, right? And these amounts we want more reserves, often more appraisals, usually a lower loan to value, so more money down, stronger credit, right? So the term is marketing language. Actual guidelines are what matter. So jumbo borrowers are not one type of client. Salaried executives, medical professionals, investors, attorneys, high net worth retirees, entrepreneurs, tech. High income does not always mean simple income. The lender holds more risk with credit depth, income durability, asset quality, reserve levels. We look at these things. So jumbo loans do not receive the same standard agency execution as conforming loans as larger loan amounts. Exceptions become more expensive for the lender. So here's a complete file, jumbo file. Credit, income, assets, property relationship. At the jumbo level, relationship is a fifth consideration. We don't look at deposits, investments, and broader banking activity. So strong credit creates more options, better interest rates, loan amount, exception, eligibility, loan to value. High income does not erase weak credit management. So one score doesn't tell the whole story. We look at number of active accounts, age of accounts, mortgage history, or installment history, size of prior obligations. So borrower with an 800 score but limited curve depth may be evaluated differently than someone with decades of substantial mortgage or credit history. So qualifying the ratio still matters, debt to income ratio, which is the total monthly obligations versus monthly income. Maximum ratios vary by lender and strength. So large reserves don't always compensate for unstable monthly payments. So remains after bill paid. So we're looking at borrower A, borrower B. Monthly income 25K, total obligations 10, cash remaining 15K. Borrower B, 100,000 a month, total obligations 40, cash remaining 60. Both have a 40% debt to income ratio, but the remaining cash flow is materially different, right? So post-close liquidity, we look at that. Reserves by loan amount. We want to see what the strength is after closing, right? So we're going to look at substantial, moderate, strong. So being able to close is not enough. The borrower must remain financially strong after closing. So not every asset is equal. So look at stocks, bonds, securities, right? Vested stock, trust account. So $1 million retirement account may not count as 1 million, right? So we have reductions based on liquidity, tax drawing restrictions, especially with RSU accounts, restricted stock accounts. So liquidity versus net worth. Net worth is total assets minus liabilities. Liquidity, assets that can be accessed relatively quick without major restriction or loss. $10 million net worth. Most real estate, private businesses, right? You'd be wealthy and still felt a reserve requirement. Liquidity is what they're really looking for here. So what will remain after the purchase? Say $1 million liquid before closing, down payment, closing costs 8, remaining liquid assets 200K. It's 13 months. This transaction should not leave the bar up rich and cash poor. We never want to do that anyway, right? So how high income can require more paperwork? W-2s, tax returns, K-1s, bonus commission history, stock comp records of restricted stock income. It's a big one we see these days, right? So we do want to see vesting schedule, things of that sort, employment contracts, trust documents, there's trust income. So the income source determines the documentation, not the home price. So salary may be the simplest part, but keep in mind, as we mentioned, we have these other items that we look at. So the lender evaluates each component separately. Total compensation, qualifying compensation may not be the same number. History and continuance matters. Jumbo qualification determines or values, dependable income more than impressive income, right? So RECs be using income. Yes, I mentioned that earlier. We want to see vesting history, current vesting schedule, stock liquidity, right? Unvested awards, employment status. RSU guidelines vary dramatically between jumbo and lenders. We work with quite a few. We have investors on what we call our secondary market. We could shop these around, but we want to make sure we meet the guideline for the transaction and for the loan type. RSU vesting timeline versus award value. Annual reward, 300,000, but the headline number is not automatically usable income, right? So we look at the vesting schedule. So the lender may calculate income based on historical vested shares, average realized value, or discounted stock value, not the full award amount. Important to remember. So the business is underwritten alongside the bar, right? For self-employed, a successful owner could still have a complicated jumbo file. We want to look at, K1s, ownership documentation, balance sheets, profit and loss, CPA verification often, right? Business bank statements. So board income versus value income, those two things are different. So what's accessible? What's usable, right? Tax allocation is not the same as personal cash flow. Can a trust help qualify? Potentially, right? We need to see the trust agreement, assets, the right to the income, duration of payments, distribution history, and of course, continuance. Continuance is a big word here for most things. So the trust must support both access and continuance. When assets create the income, right? We want to reduce asset value when we calculate it, but we'll look at checking, savings, stocks, bonds, securities, retirement accounts, trust accounts, subtract, right? Essentially, usually 60-70% of that face value if it's stocks, bonds, securities. And then we basically do a calculation thereof. So asset utilization can actually help in this case with substantial wealth. It's not limited to traditional income. So turning assets into qualifying income, here's an example. 5 million in the bank, plus funds to close, 1 million, plus reserves, 500,000. So we have remaining 3.5. We're going to do a calculation here to figure out what income can be used in that. Again, it's usually 0.7, divide that by usually 5 years to see what income looks like. If you want to use the conventional guideline, it's very tight. Fannie Mae has a guideline where you could do this, but 70%, and then they go by 360 months. It's a term of a loan, essentially. 180 months if it's a 15-year loan. So income may come from the balance sheet. So, right, retirement financing should protect the long-term plan, not simply approve the loan. Something to consider. We can look at these things. It's important to look at that. Right. Global finances create additional complexity. So if we have things, that are happening overseas, we have to do currency conversion. We do have to actually translate foreign bank statements, right? We want to make sure that we keep in line with sanctions and compliance. And of course, we have to verify asset transfer restrictions. So not every lender accepts every form of foreign income or asset. So you want to review, have a conversation with our team to go over that in great detail, and figure out what can or cannot be used if you would be asking in this spot, if you will. So structuring down payments are not one size fits all, right? This shows that Jumbo doesn't automatically need 20% down. There are 10% down options available. So the question, of course, is always to ask, hey, is it better to put less money down or more? So you want to compare the mortgage benefit with opportunity costs of each particular scenario. So small changes can affect pricing. This is a big one though. If you put less money down, tend to have a higher interest rate. It's a fact. So before increasing down payment, calculate rate improvement, payment difference, cash committed, break-even point, reserve impact. But you want to do the calculations to make sure that things work out and you're comfortable with what you're doing. Payment stability, things that we look at is, you know, structuring it based on expected holding period, not fear or habit, but we want to look at, does interest remain fixed? That's predictable principal and interest payment, long-term certainty, right? Versus arms, more risk with those arms, right? And at times there could be potentially greater upfront costs. So lower initial rate if you're looking at arm versus a 30-year fixed. It's fixed for a period, then adjust thereafter, right? There is a cap, yes, but an arm's not automatically risky. It could be used without understanding the timeline is risky. So if you're like, I know we move in 3 years, a 5-year arm is a great idea, right? If you're saying, I know I'm going to move in the next 5 years, a 10 or 7-year arm is probably a good idea. If it's going to give you a better payment. But if like, we don't know what we're going to do and you get a 5-year arm and rates happen to go higher after the 5-year fixed period, it could get you. So, match the loan to the timeline, right? So keep in mind, evaluate worst case adjusted payment before choosing an arm. Always evaluate that. So more loan structures will require down payment during an interest only period if you have an interest only loan, right? Or low down payment options, great cash flow flexibility with these programs. And so it may be a fit for those who have variable income. So let's look at that. Let's kind of show the two of them, right? Interest only payment versus a 30-year fix at a loan amount of 2 million. Let's say, we keep the rate 6.5. This is principal and interest. It's about $1,800 a month, but the fully amortizing payment reduces the principal, right? So keep in mind, if you have something just paying interest versus paying interest and paying towards the principal, think about what your goals are there, what you're trying to do, what you like to do. So moving assets may change the offer. So keep in mind that a mortgage discount's not valuable if the banking relationship costs more elsewhere. So yeah, you could reduce your rate, closing cost credit, right? You could get credit for closing costs, underwriting flexibility, but you want to, if they're saying that they're going to give you a rate that's slightly lower and you're going to bank with an institution, that means they may have asset management fees, transfer restrictions, investment changes, right? You lost your advisor relationship. So it may not always make the most amount of sense just to pull funds to get a slightly lower rate. So can investments support the purchase? This is one thing we often look at, but avoid selling appreciated assets, preserve market exposure, reduce taxable gains, support lower down payment. Those are benefits, but risks are market decline, margin or collateral calls, restriction access, right? This is investment, tax, and lending decision, not merely a mortgage feature. Always consider tax consequences. The cheapest mortgage structure may create an expensive tax event. So if you move funds from one bank to another on a whim, because you get a slightly lower rate, consider these things. These are capital gains, market risk, tax withholding, right? So buying before selling. So bridge financing can solve a timing problem, but doesn't eliminate the need to sell successfully. So yes, if you're looking to do a bridge loan, you can buy before sell the property, avoid a rush sale, strength offer, move once. Keep in mind you have multiple housing payments, bridge interest and fees, sale timing, market risk. So that's with bridge loans, right? So may help though, because you can turn equity of the property into strength. Your equity is evaluated, bridge or home equity line of credits structured, purchase without a contingency to sale, move into the new home, prepare and sell the former home the bridge is paid off. So it removes the sale contingency, can help, right? But remember that program matters more than anything when it comes to risk, timeline, and control. So two ways to access equity. If you're looking to bridge from one property to next, the home equity line of credit, which is a revolving line tied to your property, or a bridge loan. We have presentations on both. Definitely check those out if you haven't already. Now, jumbo buyers can negotiate financing too. A $50,000 credit may create more immediate benefit than a price reduction. Keep that in mind. So negotiate the transaction, not only the purchase price. So let's say option one versus option two. Let's look at it. Price reduction, lower the monthly amount modestly, reduce monthly payment modestly, reduced property basis, sure. Or seller credit towards closing costs or buying down the rate, preserve borrower cash with actual comparison before negotiating. Luxury value can be difficult to prove. So the more unique the property, the more subjective the valuation can become. Why would a lender require more than one appraisal? This is a question we get a lot. So this is dependent upon loan amount, right? Then investment, right? The risk thereof. So a second appraisal is not automatically saying something's wrong. We just want to make sure that the collateral is reviewed properly. And if there is a second appraisal, we want to make sure the value is reconciled. And it makes sense, right? So not every expensive home is easy to finance. Keep in mind, very large acreage or agricultural use, mixed use characteristics, right? Unpermitted additions. These things can be issues. So the property could be beautiful and still fall outside jumbo guidelines. So what actually secures the loan? Are the partials verified? Are they legally separate? Can they be sold independently? Do all partials secure the loan? Is there commercial or agricultural use? These are those sorts of questions, right? To start thinking about if it's one of those odd type properties. So review the partial configuration before the appraisal is ordered. Borrower in the building must qualify. Insurance, condo, litigation, structural inspections, right? A strong borrower does not cure ineligible product. Keep in mind there. So alternative jumbo options may exist. Commercial concentration, there are loans, commercial loans available. Investor concentrations, there's non-warrantable condos, litigation, short-term rentals, right? So there are these loans that could deal with that. Now, the trade-offs could potentially be slightly higher rate, more down payment, qualifying at a different loan amount of reserve. So non-warrantable doesn't always mean unfinanceable. Keep that in mind. Insurance is now part of the jumbo qualification because you want to get that insurance information early, especially in the state of California. Occupancy can change the loan. Primary residence, second or investment property. These things could change the property. So are you going to live in it? Is it going to be a vacation or second home? Or is it just an investment property? So it must reflect the actual intended use. So build the file before the offer. So you want to review income and assets, confirm reserves, select the loan structure, review property type, get a full approval, write the offer, order appraisal, then close. The larger the transaction, the less room there is for last minute financial improvising. So one thing we recommend is a to be determined underwrite. So we have everything underwritten by an underwriter. That way, everything's done for the loan except for just securing or binding the insurance policy, getting an appraisal, right? And the things that the buyer will do throughout the escrow that is really, aside from the loan inspections, what have you. The best time to discover an income problem is before the buyer finds the $3 million dream home. Huge, important to remember there. So why refinance a larger mortgage? In case you're wondering about refinancing. Refinance should improve the overall financial situation. So if it reduces monthly payment, gets a better rate. If you have an interest only, but you want to amortize it, you remove a borrower, right? Consolidate that. May make sense. If you want to access significant equity, think about, the uses of it, business investment, buy another property, debt consolidation, diversify your assets. But a cash out refinance could increase leverage, increase monthly payment, reduce future flexibility, right? So home equity is an asset. Borrowed equity is debt. Remember that. Bought with cash, could recover with delayed financing. Purchase with cash, close quickly, complete financing, recover capital, redeploy funds, replace funds from assets or to your assets. So cash may win, financing may restore the liquidity. It's called deferred financing. Lower rate does not always mean better debt. So yeah, lower rate, lower combined monthly payments, simplified obligations, potentially lower rate. Risk, short-term debt becomes long-term mortgage debt. Home secures obligation, total interest may increase. So compare savings, cost, risk, and payoff of loan. So different channels, different strengths. Let's talk about this. Private bank, relationship pricing, asset-based solution requires transferred assets. Again, maybe a risk. Mortgage banker controls processing and funding. That's where we are. Speed and execution. Broker, we could also broker. We have the ability to access multiple jumbo investors, more flexibility, and then that's kind of where your hybrid platform. So the best channel depends on borrower, property, and transaction, not the logo. Financing must strengthen the offer. Big thing you want to do. Sophisticated financial profile still means a well-presented offer. So when you make the offer, make sure the loan officer calls the listing agent. I would say be fully underwritten, verified assets. Make sure that appraisal is ordered. These are some keys that we see winning all the time. Do not structure your financial life mid-loan. Huge, not to move assets between institutions, sell off significant investments, exercise stock options, open new credit, pay off large debts unexpectedly, buy another property or a car, move money internationally. So at the jumbo level, one small change could trigger an entirely new analysis. 12 biggest jumbo mistakes, assuming jumbo's merely a larger conventional loan. 2, shopping before completing financial review. 3, using every liquid dollar for the down payment. 4, ignoring counting high balance limits. 5, treating RSU awards as guaranteed income. 6, counting liquid net worth as usable reserves. 7, moving assets during underwriting. 8, selling investments without evaluating taxes. 9, selecting an arm without modeling future payments. 10, selecting interest only for the sake of a lower payment. 12, waiting too long to address insurance or appraisal risk. 12, choosing the lender based on quoted rate. So jumbo financing rewards preparation, punishes improvising. Case study, could put 40% down. Should they? Option 1, 1.2. Option 2, 25% down, right? Smaller mortgage, lower payment. Only 300K remains. Option 2, larger mortgage, higher payment, approximately $750,000 more liquid, right? So approval is not the same as optimal structure. So case study, high compensation, complicated qualification, base salary, bonus RSUs, historical vested RSUs reviewed, bonus documented, liquid assets and asset utilization, compatible lender selected. Different lenders may calculate the same compensation differently, but this is one that we had just done, ended up closing in 10 days. So here's another one. Strong company, complex personal income, full doc jumbo. We have bank statement. This one was an asset utilization jumbo. So one business creates income, another creates a loss. Large down payment would weaken the liquidity. So the correct solution from analyzing the entire balance sheet using asset utilization worked out, right? And this is one of the situations where it was huge and it won. Another one is desire for sale contingency. Significant equity, low balance, right? They were thinking about bridge loan or HELOC, purchased new property, moved home, and then paid off the temporary financing once it's secured. So temporary financing can create control, but only when the exit strategy is realistic. So here's a playbook. Confirm the county loan limit. Compare high balance and jumbo financing. Review credit depth. Calculate every income source separately. Review business income and losses. Document RSUs, bonuses, trust early. Calculate post-closing liquidity. Compare down payment tiers. Compare fixed, ARM, interest only. Evaluate relationship priced requirements. Review the property and insurance early. Complete full underwriting for shopping. So what we want to find out are basically these things. So like when we get a call, my link's below. What's the purchase price or value? What are you looking to buy? How much do you want to put down? Let's talk about income, liquidity, right? Let's find these things for you. And then we'll evaluate how to set up the best plan specifically for your situation. So thank you for joining me. Again, links are below. If you need anything, visit me. Here are my contact numbers. You can call or text or email. Visit me on social, or simply just click the link below, schedule time to chat. Love to connect with you.